viewers, it's my Minute IAS Academy, and in this video we are going to discuss fiscal policy. So in fiscal policy we will be seeing revenue receipt, revenue expenditure, capital receipt, capital expenditure, and apart from this we will be discussing about the Consolidated Fund of India, Contingency Fund of India, and we will be also seeing about Finance Commission. And in Finance Commission, the recommendations of 14th Finance Commission as well as in 15th Finance Commission. So 15th Finance Commission is the one in which we are currently now. So we will be discussing about 15th Finance Commission, and apart from that we have Money Bill, Appropriation Bill, Budget, Economic Survey. What is budget? What are the things which are relating to it? The basic things. We are not going to see about the current year's budget and the current year's economic survey. We are going to discuss what it is. So these are the things which we are going to see now. First, let's get started. So fiscal policy. What is this fiscal policy? Fiscal policy is nothing but it deals about the government income as well as the expenditure. So fiscal policy. So in fiscal policy, it deals about government income and expenditure. It has certain decisions that government has taken relating to government's income as well as expenditure. It can increase the expenditure as well as decrease expenditure by using this fiscal policy. By using this fiscal policy, it can change the taxation also. It can bring subsidies. It can bring some schemes, social welfare programs. By using this fiscal policies, government can do so many things. Let us see one by one. First, what is this fiscal policy? It is a set of government decisions regarding the taxation, expenditure, subsidy and other financial operation. That is what fiscal policy is called. And then using this fiscal policy, government can promote saving. It can promote some socio-economic welfare. How socio-economic welfare can be promoted? By this fiscal policy, during this they introduce some schemes. By using those schemes, government can promote the socio-economic welfare of the people, and it can also promote employment. It can bring employment by some schemes like MGNREGA, Mahatma Gandhi National Rural Employment Guarantee Act. By using those schemes, government can promote employment, and it can also control the taxation. It can increase the tax or decrease the tax. These are the advantages of fiscal policy, and the main tool for the fiscal policy is budget. Budget is the main tool for fiscal policy. So in budget, we know what budget is. We have seen a budget while we are calculating our home's income as well as our home's expenditure. So budget is same. It deals about our nation. Our nation's income as well as nation expenditure is talked in our budget, in our nation's budget. So budget is the main tool for the fiscal policy. So we'll be seeing all these things, and while promoting socio-economic welfare, I have said this right. So socio-economic welfare means there are two things which you should know the difference. One is economic growth and another one is economic development. You should know the difference between growth as well as development. So economic growth is something which is relating to GDP, gross domestic product. If the GDP is increasing, then it is called as economic growth. Whereas economic development, there is an increase in GDP and also there is an increase in socio-economic development. So if there is socio-economic development as well as increase in GDP, then it is called as economic development. Whereas economic growth means it is relating to GDP. So we also should have an inclusive growth. Inclusive growth means growing with all the departments, promoting agriculture, at the same time promoting MSME sectors, promoting service sector, promoting all these sectors, and growing with all is called as inclusive sector. So by using this fiscal policy, we can bring economic development and we can also bring socio-economic welfare to the people, and we can bring inclusive growth in the society. These are the advantages of fiscal policy, or these are the features of the fiscal policy. And apart from this, we have advantages like fiscal policy also helps in controlling inflation. So we have already discussed what is inflation. So inflation is nothing but it is the persistent rise in price level is called as inflation. So fiscal policy helps to fight inflation or as deflation. Deflation is nothing but opposite to that of inflation. In deflation, the price of the products will be constantly decreasing. If there is a decrease in price compared to the normal level, then it is called as deflation. If there is a persistent rise in price, then it is called as inflation. So fiscal policy will help to fight both inflation as well as deflation by controlling the money supply in the market. Fiscal policy will help to control the money supply in the market, by which we can fight inflation as well as deflation. We can bring socio-economic welfare, we can change the taxation, and we can bring employment in the society, and we can also bring regional balanced growth. Regional balanced growth means all the regions should have a balanced growth. Growing a certain region, and if there is a imbalance means, example we can say Delhi. Delhi is witnessing more growth comparing to that of village A. Then it is imbalanced growth. All the good things are happening to Delhi, but this village A is not having any growth, means it is imbalanced. There should be regional balanced growth. This can be done by fiscal policy. How is government will bring some schemes to bring which gives incentives to the producers, which gives incentives to the manufacturers who set up a factory or an industry in village A. So that because of this incentives and the advantages which are given by the government, they will bring their industry as well as they will bring their infrastructure developments in village A. These are the ways in which government can bring regionally balanced growth. So these are the things which are done by fiscal policy. And apart from this, under fiscal policy, the main tool of fiscal policy is budget. Budget is the main tool of fiscal policy. Budget is mentioned in the constitution, but it is mentioned as annual financial statement. Budget is mentioned in the constitution as annual financial statement. It is under article 1 and 2. Article 1 and 2 talks about budget, and it says budget as annual financial statements. It contains estimated revenue and expenditure for the next financial year. It contains estimated revenue and expenditure for the next financial year, and budget is the main tool for the implementation of this fiscal policy. And we have three funds. In India, we have three funds. Let us discuss those things. First, the first fund is Consolidated Fund of India. Consolidated Fund of India. Let us see the three funds which are in India. One is Consolidated Fund of India. Second one is Public Accounts of India. And third one is Contingency Fund of India. So, first one is Consolidated Fund of India. Right. In Consolidated Fund of India, we have most of the government's revenue comes under the Consolidated Fund of India. Say government revenue, it gets revenue from many factors like taxation and other things. Taxation, through taxation like corporate tax, GST, and we have many taxes, right? Through taxes, government get a portion of revenue, right? And there are many other things from which government get revenue. Most of the government revenues comes to Consolidated Fund of India. So this Consolidated Fund of India finds mention in Constitution Article 266. Article 266 talks about Consolidated Fund of India, and to withdraw money from this Consolidated Fund of India. To withdraw money from Consolidated Fund of India, it requires Parliament permission except charged expenditure. So it requires Parliament permission to withdraw money from Consolidated Fund of India except charged expenditure. Charged expenditure, the example we can say for salary purposes, to give salary for Supreme Court judges, it is charged from Consolidated Fund of India. So, those things come under charged expenditure. For this, Parliament permission is not needed, but for other factors, Parliament permission is needed to withdraw money from Consolidated Fund of India. And then we have Public Accounts of India. Public Accounts of India is also mentioned in Constitution under Article 266 of 2. Public Accounts of India. Government income, it is not like income. The government's, it is, we have money from banks. The money which we get from banks and from Provident Fund, from small savings account, and the transport payment, everything comes under this Public Account of India. So, if we have invested, if we have kept around 2 crores in our savings account, then this comes to the Public Account of India. It just maintains, so government maintains our money in Public Account of India. So bank related money comes in Public Account of India. Third one is Contingency Fund of India. In Contingency Fund of India, Article 267 talks about it. So Contingency Fund of India will be used during national emergency. It will be used during emergency period. If there is an emergency, if the money is needed in urgent, then Contingency Fund of India can be used. So there will be 500 crores in this. From this 500 crores during emergency period, it can be used. But to withdraw money from this Contingency Fund of India, it requires permission, President permission. President should give permission to withdraw money from this Contingency Fund of India. And even if money is withdrawn from the Contingency Fund of India, say some 100 crores or 10 crores is withdrawn during an emergency, this money should be actually refilled. It should be refilled. This 500 crores is constant, and even if it is used during an emergency period, it should be refilled. It will be refilled from the Consolidated Fund of India. If Contingency Fund of India is used, it will be refilled from the Consolidated Fund of India. These are the funds that we are having, the same funds. These are the funds which the center, states are also having their Consolidated Fund of India, states are also having their Contingency Fund of India and all that. And then we have some bills. We have financial bill. Talking about financial bill, actually there are, this is the basic thing which you should know about financial bill. Financial bill, we have three categories. We can divide financial bill into three categories. First one is financial bill category 1, second one is financial bill category 2, and the third one is third one is money bill. So money bill is a financial bill, but not all money bill is financial bill. Okay? So sorry. All money bill is a financial bill. Money bill is a financial bill, but not all financial bill is money bill. Okay? So financial bill, article 110 talks about money bill, and article 107 generally talks about the financial bill. This financial bill is introduced to increase or decrease or abolish a tax. To increase or decrease or abolish a tax, financial bill is used, and Parliament should give permission. For this also Parliament should give a permission. This is relating to financial bill. And then we have Appropriation Bill. Earlier we have talked about Consolidated Fund of India, right? So this Appropriation Bill is the one which gives permission to the Parliament to spend money from the Consolidated Fund of India. So Article 114 talks about Appropriation Bill. So earlier we talked about Consolidated Fund of India, in which most of the government's revenue will come, in which to withdraw money from the Consolidated Fund of India, it requires Parliament permission except charged expenditure. Example for charged expenditure, we have salaries that need to be paid for the Supreme Court judges and all of this. So those things come under charged expenditure, except charged expenditure. For other things, it requires parliamentary permission. For that, we pass a bill that is called as Appropriation Bill. To withdraw money from the Consolidated Fund of India, we pass a bill that is called as Appropriation Bill. Article 114 talks about it, and this gives permission to the Parliament to spend money from the Consolidated Fund of India. This bill should be passed. And other than this Appropriation Bill and Finance Bill, we have Money Bill. Article 110 talks about Money Bill. So Money Bill is a financial bill, but not all financial bill is a money bill. And Money Bill should be certified by the Speaker as Money Bill. So the bill should be certified as Money Bill by the Speaker, and it is introduced in Lok Sabha only. Money Bill is introduced in Lok Sabha only, and these are the things which are relating to Money Bill. So we have seen some bills. We have seen Financial Bill, Appropriation Bill, and then Money Bill, and we have seen some funds: Consolidated Fund of India, Contingency Fund of India, and Public Accounts of India. We have seen what is fiscal policy, and we have seen what is budget. Budget, Article 1. So Article 112. Article 112 talks about. Article 112 talks about budget. Article 110 talks about financial bill. Article 117 talks about. Article 112 talks about budget. Article 110 talks about money bill. Article 117 talks about financial bill, and Article 266 talks about Consolidated Fund of India, and Article 266(2) talks about Public Accounts of India, and Article 267 talks about Contingency Fund of India. These are the articles which we have seen up to now, and Article 114 talks about Appropriation Bill. These are the articles which we have seen up to now, and after this we have financial year. Generally the financial year which we have now is from 1st April to 31st March. It's called as financial April. It starts from 1st April and it's in 31st March. This is called as financial year. It is introduced in 1967. 1967 it is introduced, which means it is introduced. Sorry, I am not sure about 1967 because financial year from 1st April to 31st March is introduced by British. I am not sure about it. So I will refer to it, and I will say it in the next video. Actually in 2016 there is a committee which recommended to change this financial year from 1st January to 31st December. So it recommended to change the financial year from 1st January to 31st December. It is in 2016 this committee was formed and it is called as Shankaracharya Committee. Shankaracharya Committee recommended to change the financial year from 1st January to 31st March, but it is not implemented. So it is relating to financial year. So Shankaracharya Committee is relating to financial year, but it was not implemented. And then we have vote on account. Vote on account is nothing but it is the money which is needed to spend during the 2 months. So the money will be needed during the February and March, right? During February and March only the budget will be passed. The budget and the economic survey, money allocation will be done during this period. But during this period also money is needed, right? So what I am saying is the budget will be passed. The budget will be presented, then it will be passed by the parliament. There is a process. During that process, we need a money. So during that process, the government needs money and that money, it will be charged. And that money is called as vote on account. While passing the budget, while allocating the funds, during that period, February, March, the government needs money. So the money that is needed during February, March, that means the 2 months during which the budget is passed and all that, can be granted by this vote on account. So it will be allocated around 1/6. 1/6 of the budget can be allocated as vote on account. And these are the things which are relating to vote on account. I am talking about budget. During budget will be presented. Generally, budget will be presented on the first working day of February. Budget is presented during first working day of February, and a day before budget is presented, economic survey will be presented. So first working day of February is the day in which budget is presented. After this, it should be passed by the parliament. The funds should be allocated. The period from first working day February to March, the period government needs money for which vote on account is used. Vote on account will grant money. So by using this vote on account, money will be granted for the February and March, and 1/6 of the budget can be granted as vote on account. This is the basic thing, and budget will be passed during first working day of February. And then we have interim budget. Interim budget is presented during extreme situations, or it is presented by the opposite party. So the party that wins, so interim budget is not mentioned in the constitution. First point is it is not mentioned in the constitution. During election or some extreme situations only interim budget is presented. And if say a party is ruling and another party has made an interim budget, then if that party wins, it will be continued, or else if a new party has won the election, then it will create a new budget, and this is called as interim budget. Then we have economic survey. So earlier I have said economic survey will be presented a day before budget is presented, and budget is presented in the first working day of February, and economic survey will be presented a day before budget. So economic survey will be presented by the chief economic advisor. So economic survey has 2 volumes. One is volume 1, another one is volume 2. Volume 1 talks about the future suggestion as well as the projections. It talks about the future. Generally, volume 1 talks about future, whereas volume 2 talks about the past year data. So volume 2 is more important for the UPSC prelims exam because it talks about the past year data. For prelims exam, volume 2 is more important, whereas for mains exam, volume 1 is important. So if you are preparing for prelims, give focus on volume 2. If you are preparing for mains, give focus on volume 1. And this economic survey is prepared by Chief Economic Advisor. K. Subramaniam is now the Chief Economic Advisor of India, and economic survey will be presented a day before budget is presented, and it has 2 volumes. One is volume 1, another one is volume 2. Volume 1 has future suggestion and volume 2 has past year data. These are the things which are relating to economic survey. And then let us talk about the Chief Economic Advisor. Chief Economic Advisor will come under the Ministry of Finance. He come under the Ministry of Finance. And he is under the department, under Ministry of Finance, he is under the Department of Economic Affairs. He is under the Department of Economic Affairs under the Ministry of Finance. So Chief Economic Advisor is under the Ministry of Finance and under the Department of Economic Advisor, and it is not a constitutional post, and the Chief Economic Advisor tenure is for 3 years, and he gives advice to the Government of India on economy matters. And he presents the economic survey. He is the one who does economic survey. These are the things which are relating to Chief Economic Advisor. And then let us talk about the departments which come under the finance ministry. There are certain departments which come under the finance ministry. Ministry of Finance we are going to talk now. So under Ministry of Finance, first department which we are going to talk is Department of Economic Affairs. In Department of Economic Affairs, their main job is to do fiscal policy and the preparation of budget. So Department of Economic Affairs, their main job is fiscal policy, presentation of budget, preparation of budget, and this Department of Economic Affairs is the one. Under this only we have Chief Economic Advisor who prepares the economic survey. So relating budget and economic survey, we have Department of Economic Affairs. Then second one is Department of Expenditure. So it talks about how much money to be spent from the Consolidated Fund of India and how it is spent. How money is spent, how much is spent, everything will be discussed in this Department of Expenditure. And third one is we have Department of Revenue. It talks about the government's revenue, the ways, the means in which government is getting revenue. It analyzes and studies the government revenue. That's it. Fourth one is we have Department of Financial Service. Department of Financial Service will work towards the financial inclusion. It works on inclusive growth. Department of Financial Service. So financial inclusion means banking service to all, financial service to all. It gives schemes for financial inclusion. That is Department of Financial Service. Fifth one is we have DIPAM. DIPAM is in news. It is the most important thing which is under the Ministry of Finance for the UPSC Civil Service exam 2021. DIPAM means Department for Investment and Public Asset Management. Department for Investment and Public Asset Management is called as DIPAM. Earlier it is called as Department of Investment, but now it is called as Department of Investment and Public Asset Management. Why? Because now it is the one who is doing disinvestment policies. It is the one which is recommending disinvestment, and the idea of disinvestment of the LIC, to sell railways, airline, everything is by this DIPAM. So it is in news. It is important. And sixth department is Department of Indian Audit and Account. Department of Indian Audit and Account. Indian Audit and Account Department is the sixth one. Under this only we have Comptroller Auditor General of India. Comptroller Auditor General of India is under the Department of Audit and Indian Audit and Account. So Indian Audit and Account Department, under this we have Comptroller and Auditor General of India. He is the head of this department and it is a constitutional post. Earlier we have seen Chief Economic Advisor, who is not a constitutional post, but Comptroller and Auditor General of India is a constitutional post. These are the things which are relating to Ministry of Finance. And after this, let us see fiscal policy, budget. In budget we have revenue, capital. Let us see those things first. Let us see those stuffs in our next video, part 2. So these are the things which are the basics of fiscal policy. These are the things which are basic relating to fiscal policy, budget, financial bill, money bill, and Consolidated Fund of India, Contingency Fund of India, and the Department of Finance Ministry. Everything is Finance Ministry, the departments under Finance Ministry, everything is discussed in this video, and in the upcoming video, part 2, we will be discussing the budget. Subscribe to my IAS Academy. Thank you.